Hi class. Today we are going to talk about how a borrower qualifies for a residential loan. For some of you, this may be the first time hearing these lending concepts, and that is completely normal. One of the easiest ways to understand mortgage qualification is to think of it as a three-legged stool. For the stool to stay stable, all three legs need to work together. Those three legs are credit score, debt-to-income ratio, and down payment. If one leg becomes weak, the borrower may still qualify, but they may need a different loan program or stronger compensating factors. So let's break down each leg of the stool. Let's start with the first leg, the borrower's credit score. The credit score tells the lender how the borrower has handled debt in the past. In general, a score of 740 or higher is considered very strong. Scores in the 700s are generally considered good. Around 620 is often the minimum for many conventional loans. Around 580 may still work for FHA financing. The stronger the credit score, the more financing options the borrower may have. A stronger score may also help the borrower receive a better interest rate. A lower credit score does not always mean the borrower cannot buy a home, but it may change the loan program, down payment requirements, or monthly payment. Now, let's look at the second leg of the stool. Debt-to-income ratio. Debt-to-income ratio, also called DTI, compares the borrower's monthly debt payments to their gross monthly income. The lender wants to answer one major question: can the borrower realistically afford the payment? For example, a borrower may earn a good income, but if they already have large car payments, student loans, credit cards, or other monthly debts, that affects how much house they may qualify for. In general, lenders prefer lower debt ratios because it reduces lending risk. Income matters, but so does existing debt. The third leg of the stool is loan-to-value, also known as LTV. Loan-to-value compares the loan amount to the property value. The borrower's down payment directly affects the LTV. For example, putting 20% down creates an 80% loan-to-value. Putting 10% down creates a 90% loan-to-value. The larger the down payment, the lower the lender's risk tends to be. In some cases, larger down payments may also help borrowers avoid mortgage insurance. This is why down payment funds are such an important part of the loan approval process. Now let's connect these concepts to common residential loan programs. Different borrowers fit different loan programs. For example, a borrower with stronger credit and stable finances may qualify for a conventional conforming loan. A borrower with lower credit, such as around a 580 score, may fit better into an FHA loan program. An eligible veteran may qualify for a VA loan with little or even no down payment. And buyers purchasing higher-priced homes above county loan limits may need jumbo financing, which often requires stronger credit and larger reserves. This is why understanding financing is so important in real estate. Not every borrower fits the same loan type.
So what does this mean for you as future real estate professionals? It is important to understand that agents do not approve loans. That is the lender's job. However, knowledgeable agents understand financing basics, so they can guide buyers, ask better questions, help set realistic expectations, and avoid problems during escrow. Before writing an offer, an agent should generally understand the buyer's approximate approval amount, the loan program being used, the available down payment, and possible financing limitations. The main takeaway is this: loan qualification is not based on just one factor. Lenders evaluate credit, income, debt, down payment, and overall risk together. That is why the three-legged stool is such a helpful visual. If one leg becomes weak, the entire loan structure can become unstable. The more you understand financing, the more confident and valuable you become as a real estate professional.
Even learning these basic concepts now can help separate you from many new agents entering the industry. Thank you for watching, and I will see you in the next lesson.